Hey everyone, and we are live with another episode of Punch Card Investing. Always happy to have everyone joining us. I've been told that for those of you who tune in live, the ad runs for a little bit, so I'm going to go ahead and wait about 10 seconds before I really start diving into today's intro. And there, we have a bunch of people just join the show. So for those of you who've been complaining, I've heard your complaints. I'm going to try to slow down the intro a little bit, slow play it, so you don't miss anything out. Miss anything if you
don't
show
want
up
to
right
miss
at
any of
time.
Jack's intro here.
Yeah,
Don't
no,
miss
yeah,
anything.
it's a key part of the show.
Pure gold.
Because that's
It
when I
is.
tell you to smash the like button, to subscribe, and check out all the stuff in the description, including the Discord. We also have our beautiful link to ShareSite, where you can track your portfolio. You can open up a free account there, or if you use a paid account, use our link below. You get some free months, and we get an affiliate commission there too. So you're going towards helping the channel as well, which is always a great thing. Speaking of which, before we dive into today's topic, I want to definitely take a look at Alibaba, given its precipitous decline, as well as Facebook, which have both just continued to hit new. I don't want to say new all-time. They're definitely not all-time lows, but new recent lows for sure. Well off their all-time highs, and see if maybe the game has changed for either, or if this is just Mr. Market acting up, since there's plenty to talk about with either of the companies because they're so huge, being Baba and Facebook. And then there's plenty of other stuff to talk about as well, and we'll try to get to your questions as well. And we should be having Karan join us as well in just a moment, so stay tuned for that. Tom is out looking for a house, and this is his one time of the week where he goes and does that with so we are rooting for Tom to get that house so that he can get his Saturdays back. Anyways, let's take a look at the punch card portfolio, just because it's kind of hilarious, and we're all feeling the pain together. We started off with $1 million in portfolio value back in, I think, October, and we are down 21% since then. Baba just leading the way, down 47%. Seritage was leading the losers for a while, but is all the way back up to a negative 25% run, which is good for them. And as per usual, KPG just pulling ahead, or not even pulling ahead. Just staying, cementing itself as the rest fall behind. I think that's the better way to put it. So that's what's going on with the punch card portfolio. Man, should we have a vote if Karan's on? We can do our vote. I guess if the three of us vote to add a stock to the portfolio, aka Facebook, I know we've been talking about possibly doing that as the stock continues to fall. Maybe we could do that later in this episode. We can decide on that, because if we get 3 out of 5 people to vote to add a new holding, then we kick the vote out to all you lovely people on our community posts. And you can vote for which stock gets booted out of the portfolio. So it'd be one of these 5 in totality, and it would just be the I guess we'll do plurality vote rather than a majority, because that would get messy. You'd have to have revotes and everything. So the plurality would be what gets kicked out. So it'll be nice and dramatic when that time comes. So definitely subscribe so don't miss that. Sandeep says we've beat ARK, so there's something there. So there's a method to the madness, I suppose. As long as you're not the biggest loser, that's what really matters. Risk-adjusted losses.
When did you say we started the portfolio? I'm surprised Alibaba's down 47% in just a few months, I think.
Yeah, since October 29th.
Oh, there it is right there. Yeah, that's crazy.
October 29th. Yeah, it is crazy, because it was already down. What's our cost basis? Around 130-ish? Whatever that is, whatever that equates to. It was already down a bit from like where Charlie Munger bought it the first time around, I should say. Yeah, it hasn't been too fun, especially compared to S&P during that time, down only 8.5%. Hey, but that's the name of the game when you're got a concentrated portfolio. You're gonna have to sit through some volatility, and that if you can sit through these rough times, you get ideally much prettier times at the other end. It's the name of the game.
Yeah, if only we had more upside volatility like Frank the Tank.
Yeah, we need like 2 more of those, and then if we bat 60% rather than 20%, we'd be in really good shape.
That's okay. we're
Give it
gonna
time.
sit tight here.
Give it time. We're only at like 6 months, so not even. Oh, one more thing. Big announcement, guys. If you haven't seen, our very own Brad Kellner, the stock compounder, started his own newsletter. He just announced it on Twitter. Let me share that as well. But go ahead and check out Brad's Twitter right here. You can join his Friday green pitch. Yeah, I'm excited for this, Brad. We got another newsletter in the mix of the Punch Card crew. Frank, you've been doing yours for a little while. So yeah, this is exciting stuff. Congrats, and everyone go check out Brad's newsletter.
Thank you. Thank you very much. Should we attack a few questions before we kind of go into the topic for today?
Yeah, sure. Let's invert. Let's do some more questions up front rather than any catch your eye, Brad.
Should
we start with Baba focused stuff or Facebook focused first? Probably Baba.
Sure. Where's the Baba questions?
I don't know if there's any specifically for Alibaba.
All right, we could do some non-specific questions. Jesse has a few here at the top that are some kind of quick hitting ones. Maybe yes, for favorite CEO. We did that capital allocators episode a while back. And the favorite CEO that comes to mind. Zuck. He is our background again.
I really do like Brett Kelly for an off the kind of beaten path kind of one for a micro cap, I guess. But it's hard to go past like Buffett or someone when you really think about it that way. Yeah. Buffett is obviously, if I had to pick someone, that's the guy. He's just a bit old.
You just have a level of comfort knowing that he's at the helm. It's like he's not going to do anything reckless. He's probably going to be right most of the time, or enough of the time that it creates outsized returns. So yeah.
But actually, Pony Ma is another one that I think is one of the best capital allocators in the world. And he's a bit younger, so maybe that's a better pick.
How old is he? Yeah. He's probably in his 50s, I would think.
Actually, I have no idea, but he doesn't look old. So,
right.
he looks actually, he started the company. He'd be like mid 40s because he started the company in his early 20s, and that was about 20 years ago now. So,
yep,
close to 50.
Cool.
Brad, any come to mind for you?
Yeah, I mean, Buffett, Pony Ma are great answers. I remember, for some reason, Chamath answering this question. And he ripped off the answers he gave. Bezos, Lutke of Shopify. Who's Jack Dorsey, Elon Musk. I can't remember the last one, but some big hitters in there, obviously.
Yeah, all the evil tech geniuses.
Right.
So Bezos no longer a CEO though. He's stepped down. But
that's right.
Still. Yeah, if I had to pick like a favorite, just like certainly most entertaining has to be Elon, right?
So, yeah, I guess it depends how you define favorite, right?
Favorite being I'd want to invest alongside. In that case, that I could get behind that too at the right price.
Yeah, Pabrai has pointed out that Elon doesn't seem to really care about money. Like he's not in the game of trying to maximize shareholder value. He's trying to change the world in a sense, right? So there could be a little bit of a misalignment there, but
well, I would to that. I think this is the problem of business in general, in that in an ideal capitalist sort of system, the idea is that the bigger the problem, the bigger the payoff, the bigger the problem that you solve, I should say. So
sure.
So as long as you're focusing on solving the problem, ideally there's a big payoff at the end. Now there are exceptions and corruption and inefficiency and all that, but I wouldn't say that those two things are necessarily misaligned.
Sure. I guess the other question is who gets the payoff, right?
Yeah.
If you structure it so that you get all these options. The way Elon structured it, it's questionable how much of that value is transferring to shareholders versus the management. But
sure, fair.
Okay, what else do we see here?
Good question. Thank you, Jesse.
Yeah, thanks, Jesse. Who's
Quick
short
one on-
Thor?
I got a quick one on books.
Yeah, books on pre-order. So I just got a book. You guys, I got to say, this book I ordered, Seeking Wisdom, from Peter Bevlin.
Not to be confused with Seeking Value, Frank's Frank's podcast.
No, they're different, although I'm sure there's some overlap. This book got to me in less than 12 hours on Amazon.
Nice.
And I didn't pay any extra, right? It was part of the Prime. So it's almost too fast. It's like you guys you're trying a little too hard. I don't need this until tomorrow.
You want to linger a little bit.
Let me anticipate a little bit, So it's a good problem to have, I guess, but it's wild.
I actually just made a list of the books I want to read at some point. I quickly shelled out like 75. I just am putting together a proper reading list that I could always just point to and be like, all right, I want to read this one next. I'm about to finish Guns, Germs, and Steel at long last.
Wow.
And now that I'm commuting more again, so I'm making more reading time on the train. And what's after that? A buddy at work recommended a book on Enlightenment ideals. Jonathan Israel wrote a series titled like The Radical Enlightenment. So it's kind of like a history of ideas. So I might be reading that next, since he lent me the book. So I'll probably be reading that. As a partner at the law firm who heard I was reading Guns, Germs, and Steel and asked if I was interested in that sort of stuff. So I was like, all right, sure, if you recommend it. So that'll probably be next. And then I might get back into more like a finance related book after that.
Cool.
Frank?
Enlightenment.
I've got nothing exciting to read, actually. I'm looking for something new. I've decided I'm going to reread some of Buffett's really old letters. I read them a long time ago, but it was before I had a good understanding of investing, I think. So I think I'm going to revisit some of the real old Buffett letters as far back as I can go.
Nice.
Have either of you read I think it's Sons of Wichita? I think it's a book about Buffett and someone else in particular. I've seen that right, Sons of Wichita. No, sorry, it's about that's actually about the Koch brothers. For some reason, I thought it was Buffett.
Wichita didn't sound right for that.
Yeah. Excuse me, that's a slip. But I've been seeing that one thrown around for some reason. But anyways,
Frank, there's a book I've been listening to a little bit called Tap Dancing to Work by Carol Loomis, and it's kind of a compilation of articles about Buffett. It includes his big paper on inflation. I think that was written in like 1977 or something like that. How inflation swindles the equity investor. So you might enjoy that. It's kind of moving through time.
Nice.
Yep.
I actually might throw it out there. Does anyone in the comments even know something about Buffett's early days? I want to really look through when Buffett was doing these more special situation, micro cap type investments, less kind of famous, looking at the more obscure stuff. But I don't know if there's anything out there that exists that focuses specifically on that. I guess all the famous books like Snowball kind of touch on it. But yeah, that'd be something I want to come across.
I wonder if with the complete financial history of Berkshire Hathaway, have you kind of paged through that, looking at the early years?
I haven't got my hands on. That's the Adam Mead one, right?
Yeah, Adam Mead. Yeah.
Yeah, no, I haven't seen that yet. I guess that covers everything, so that might be a good one to start with anyway.
Yeah.
I think Jesse just said that in the chat too.
Great minds. Cool.
Thank you again, Jesse. Maybe now's a good time to pivot towards Baba. Dr. Ali Dugar says, How much percentage of portfolio you guys are holding in Baba? And if the price keeps declining, what's the max percentage you would allow despite it continuing to fall, I suppose? So how is there kind of a minimum threshold you're looking to keep if it continues to fall, or is that not really a consideration? Either way, what kind of percentage are we at right now?
I'm actually just pulling up my portfolio so I
Yeah,
can get
same,
it
same.
exact for you.
Yeah, I put in 20% at cost when it was like above 200. And that was my approach. Like, okay, I'm just gonna make a full bet now. I'm not gonna chase it down. If it keeps falling, obviously that wasn't an optimized choice, but
I respect it.
who knows in hindsight, right?
Right.
But yes, I haven't bought on the way down. It's
It
less than
stings.
20 now because it's dropped a lot. But
It
honestly,
stings.
I've been trying not to look at it.
Too bad you're on this show.
Yeah, I know it makes it difficult, doesn't it?
It stings, but I appreciate the discipline to stick with the method, because
Yeah.
that's the hardest part of any sort of investment strategy. It's the discipline to stick with it.
Right. Frank, what do you got?
7% it currently is, which
Okay.
I think when I originally made the investment, it was around a 15% bet, I want to guess. But I've added capital to the portfolio since then, and obviously it's down significantly. Maximum wise, not specifically for Alibaba, but kind of Chinese stocks in general, say maybe 25% of the portfolio is kind of the range I would like to keep it under. It is significantly under that at the moment. I think we're just looking now, the Tencent Prosus combination is about 8.5%, and then Baba at 7%. So,
and that's all you've got in China, right, Frank?
Yeah. So theoretically, if I wanted to add to the position, I have no reason not to, other than the fact I want more capital. I'm still building up enough to enter a reasonable size position, but it is incredibly cheap. But yeah, there's obviously a lot of uncertainty in that as well. So I don't want to over allocate to Alibaba.
Baba is right now about 3.5% of the portfolio. So I think at its, if you based on that my cost basis, it's about a 5% bet, but down to 3.5 or so now. I think my cost basis is around 140 or 130 ish. So, and now it's below 90. So, about 3.5% right now of my.
What was your thinking on the 5% allocation? If I could have
It's sort of similar to Frank's, in that I don't want too much exposure to China, just given its sort of unique risks, that I'm not as comfortable to say like, all right, let's make this 20% of the portfolio tomorrow. Plus I like having a little bit more, and there is also this issue with Baba in general, just being a large cap company, and that limits some of your upside. I know that, Frank, that's a big reason you look a lot at smaller micro caps, kind of less liquid, ideally a bigger runway for growth, because you're starting with a smaller basis. So that's part of the hesitation, though that's not a huge issue. For example, I'm adding to Facebook as well, which has the same sort of problem in that it's a $500 billion company. So how much can you really grow from that point compared to, say, $100 million company that could 10x, quote unquote, easier and more easily than a
like Turtle Beach, for example.
Yeah, right, exactly. But that's kind of my thinking there, in that I don't want to just fill it up with mega caps, especially because my retirement funds are in index funds that have plenty of large caps making up a huge portion of them, just based on their market share. So that's kind of how I justified in my head, in that I don't want to go too heavy, unless it's just a screaming deal, which Baba certainly seems like a very nice deal, so that's why it's in my portfolio. But that's probably why I don't want to go far above, say, maybe 10% of the portfolio, if I had to put like an arbitrary sort of limit on it.
Cool.
I just saw a comment regarding that Buffett thing I brought up, the early Buffett days. SC said, hit up Andrew Kuhn for a 5K page Buffett master PDF, something from inception to 2018. I just opened that up. If you don't know Andrew Kuhn, he hosts a great podcast with Jeff Gannon. Two super smart guys. They run a fund called Focus Compounding. Same name for the podcast. Super smart guys. They focus on small illiquid securities. It's probably my favorite investing podcast. But I didn't know that existed, so thanks for that one. I just pulled it up, and I'll definitely be reading through that.
Nice.
Thank you, SC. What else on Baba? How do we think of? So we're seeing these big systemic issues, especially with the Russia-Ukraine situation. We're seeing a lot of financial sanctions, not just against the country of Russia, but also against individuals, and a lot of financial institutions literally pulling out of Russia, for example, and just those sorts of issues where maybe money gets locked up, money gets taken out, you get like a liquidity crisis of sorts. And I know a lot of investors are thinking about that with China as well, with potential future conflicts with anyone, whether it be the U.S. or whatever. Does that weigh on your decision at all with how you allocate towards Alibaba or Tencent or really any Chinese company with this recent conflict in Russia? Does that change the game fundamentally for you guys?
I try to ignore it. I try to focus on the fundamentals, I guess, the actual business, and ignore the unknowable macro considerations. Of course, you have to think about it, and it is a risk factor, but it's an unknowable risk factor. I guess just to push back slightly when it comes to, I guess, foreign kind of intervention and invading other countries, America and Russia have done that in the past 20, 30 years. China haven't done any of that whatsoever. The only risk, I guess, would be Taiwan, but it's unlikely, I think, to have some real major event. Not to say there won't be these smaller things over time, but they always exist as a risk, I guess. But I wouldn't expect it to be in a situation like Russia right now. And even if it was, it's so unknowable and unpredictable that I don't think it's worth considering too much. It's just part of that downside risk.
Yeah, I second that. But, I'll note, people are going to extrapolate what's happening in Russia and Ukraine to all kinds of different markets and get carried away with the perceived risk. And when that happens, there can be great opportunities to buy below value. So I think people tend to overshoot when it comes to that. So I just wanted to add that.
So maybe it's a welcome thing
Wow.
for someone looking to make $1. No,
Yeah.
we don't like conflict here.
No,
but yeah, it's like peak fear right now in
Right.
a lot of spots. So
well, we don't know if it's peak yet.
well, yeah, of course, it's at peak an all-time high or a 52-week high in fear. How about that?
Sure.
it comes and goes. I wonder. I do think that might be what's causing a good bit of this recent Alibaba sell-off. Granted, it kind of just has been always selling off since Charlie Munger bought in, pretty much. His initial purchase, that is. So, but there has been a pretty significant drop recently, and I wonder if that has anything to do with it. I haven't looked too closely at other Chinese stocks, and I wonder if it's following kind of in line with that.
That's more related to the delisting fees that kind of come up again with the recent changes on the SEC website. I'm not going to pretend to understand this more than I actually do, but they listed 5 Chinese listed ADRs that were a potential delisting, and there was changes kind of around the regulations around audits on their financial statements. And I think it's something like if they consistently don't report in a certain way for a 3-year time period, then there's a risk of being delisted. They didn't mention Alibaba, but I think just the fact that it was brought up in the news again,
the sentiment,
investors, yeah.
Did you catch how close those companies are to being delisted? Like where they're at in that 3-year time frame, or no?
No idea. There's also rumors that the 3-year time frame will be decreased down to 2 years, but regardless, I don't think that's a huge concern for Alibaba. I don't think they want that capital from investors in America. So I don't think, international investors in general, I guess, I don't think they'd be stupid enough to do that. And worst case, if it happened, you would have the option just to switch to the Chinese listing in Alibaba anyway. But of course, there would be a huge effect in share price in that type of event. I just don't think it would happen.
It's sort of on that note, is there a price where Baba is a no-brainer, says Jacob? If it continues to fall, it offers a bigger multi-bagger than a 2-3x, of course, the law of big numbers. Is there Brad, I think this is a good question for you, since you say you started with your full position. But what if it halves from here? Well, surely you got to be a little bit interested, as long as nothing fundamental is.
If Baba becomes a small cap, I start to get very interested very quickly.
Sure.
So
that'd be pretty rough for current shareholders.
Yeah.
So right now, valuation wise, I think Alibaba's projected revenues are around 155 billion roughly for next year. So they're at a price to free cash flow multiple of around 9 times, and if you back out cash, that's like 7 times free cash flow. So I don't know how much cheaper it can get, regardless of the risk involved. 7 times free cash flow for a company like Alibaba is pretty insane.
Even if you're a private shareholder, if it gets delisted or something, you're taken off the public markets.
If it halved, then you're looking at 3.5 times cash flow. That's free cash flow. That's insane, and a definite no-brainer at that price. But I don't know. I think it's been a no-brainer for a while almost, but I'm willing to take on more risk than most people, so it's not for everyone.
Yeah, it does depend on your what your threshold is. That goes for anyone.
Yeah. I saw a comment about Occidental Petroleum. Have you guys dug into that at all? Seeing that Berkshire Hathaway was buying in, it's really not in my
lots of people buying into oil right now.
Yeah, have you been paying attention to that, Jack? What are your thoughts on that?
I mean, a fair bit. Just commodities in general, they've been kind of one of my one saving grace in my portfolio. I have a decent exposure to mainly metals, so copper, uranium is in there, a lot of gold and gold miners. And that has served me well in the last few weeks, whereas pretty much everything else has not. So a lot of people are, especially with this Russian conflict, Russia has massive natural resources that it sells to the world. And if that gets cut off, the US and parts of Europe are cutting themselves off from Russian energy assets. And that would imply that Europe or the US is going to get their energy from somewhere else. And when that happens, you have the same amount of demand, but less supply. And therefore, up goes commodity prices, like oil in particular. So it strikes me as a much shorter term sort of play. And by short, I mean maybe a year or two. It obviously depends on how long the conflict goes, what happens after the conflict, do sanctions remain? So it's inherently a bit speculative, but especially in a high inflationary environment, you could see the appeal to something like a commodity while you're waiting to deploy your capital towards something else. In the meantime, ride up the commodities while the dollar goes down or whatever currency goes down relative to the commodities. So you can see the appeal, but it is kind of a different game that I can't say I'm an expert on. But you could definitely see why some of these commodity companies or even the commodity itself can look pretty attractive right now.
Do you know, Jack, where your uranium holding is domiciled? I think it's Kazatomprom. That's a pretty big uranium producer in Russia. I think it's in Russia. I don't know where uranium is found.
It's actually just an ETF, so it's a bunch of uranium
miners. It's an ETF. Okay.
Yeah. I forget the ticker, but I'm getting it right now. I think it's just URA.
Makes sense.
Yeah. URA, Global X Uranium ETF. And I think it's a pretty broad mix, but let me actually pull up the actual prospectus and I'll get you an answer.
Ooh. You're going all in.
Da-da-da. Oh, where is it? Talk about something else while I find this.
Yeah, so Jesse thinks Buffett's going to talk about maxims to think analytically, which is a book on the thinking of Richard, I think it's Richard Zeckhauser, who's a Harvard professor. And I remember Charlie making reference to Zeckhauser at one point, how Zeckhauser thinks about playing bridge or something like that. I can see it's a lot of respect for Zeckhauser. So I do have that book. on hold at the library, so I'm excited to check that out.
And with that intermission, thank you, Brad. Here are the top holdings in URA, the Uranium Miners Fund.
Doesn't say where they're located, but that's all right.
No.
Canadian,
Well, you sort of where they're listed at least.
Oh, yeah, not where their activities are, most likely.
Yeah. So a little top heavy here, but otherwise pretty much all over the place.
Okay.
Do you guys know where that news on Occidental Petroleum came out? I actually missed that completely. How do we know that Buffett's buying that?
I saw. I mean, we all saw Chevron, but that was last quarter.
It was in Data Roma under the real time tab. If you want to go to that, Jack.
And then do we have an idea of when that was happening? Because I'm just curious because the stock's up. It's been a double since the start of the year, which is
it gives the dates.
Crazy.
It was on the 4th and the 11th were the
So it was
last
3
week,
times
really.
free cash flow at the start of the year. Now it's 6 times free cash flow. So
has it really shot up over the last week?
Let me have a look.
It's
more so over the course of the year. This week, not so much.
This is a pretty significant amount. No, we're talking.
Is it
a few billion? No, if I'm reading, if I'm reading this correctly,
I wonder what percent increase that is.
Well, they said 4.5 billion in the chat.
Like,
in total.
Yeah, that's a pretty big swing by Berkshire standards.
Yeah, just over the last 2 weeks, it's up 50%.
What's the market cap of Occidental?
Just over 50 billion.
Yeah,
50 billion.
Big chunk of the company right there.
Yeah.
So that's likely the first actual Buffett swing in a while.
Yeah,
I would guess.
Well, he bought Chevron, I think, in the 4th quarter, right?
That was pretty small though compared to this.
Added to Chevron. Yeah, I don't know how big that was.
Yeah, it's hard to know. It's hard to know what Buffett's actually doing. I feel like it's pretty unknowable, but I would like to think it's only the really big moves in the portfolio. And then it's hard to think about that as well because Apple's so much of the portfolio that relative everything seems small. So
yeah. Right. Well, and I always just try to compare it to like the cash pile of like well over 100 billion, 150 billion, we'll call it. That's kind of like my measuring stick. It's like how much of that are they deploying? Granted, they're always going to have a lot of that set aside for insurance float, but I think that might be the better way to kind of measure how big the conviction is. Though it's such a gigantic fund at this point, it's a little bit hard. But yeah, I think this is the biggest since the Dominion Energy deal from a while back where they bought all the gas rights.
So Sandeep's saying 17% position by Berkshire. I don't know how that math works out.
He says 9% recent, so these last 2 weeks, and 8% old existing via rights. So they must have warrants or something, or even options. Probably warrants.
Just looking through ownership on ticker now. It's got Berkshire at 3%.
Right. That may have been before this recent buy.
Possibly.
Oh, yeah. It's hard to say.
Yeah, interesting anyway. I don't understand oil and commodities enough to make a big bet. Yeah. If I was to do anything like that, it would be a basket bet of a handful of companies, but it would just take so much work for me to get comfortable to allocate any capital towards an oil company or any commodity company, really. And that's not to say it doesn't work out. I think it's probably a great space to be looking in. It's just not a space I understand well. So I don't know.
And in any event, it's always tied to the price of the commodity, which is difficult to predict long term and even short term. Arguably harder short term because look what just happened. Well, oil was trending up, but look what happened just in a couple of weeks with this conflict opening up. Now it's skyrocketing among many other commodities as well. So, and it could easily pull back if we get news about sanctions being lifted or whatever. So it's not as though things are set in stone, not by any means.
It looks like Buffett did a CNBC interview recently that Jesse has on his page about Occidental Petroleum. So could be one to look at if you're interested.
Yeah. Shall we talk a little bit about anything more on Baba? I'm scanning questions here. Or should we talk a moment about Facebook? Because that is also...
I think we can wrap on Baba. Yeah, what do you guys... I will say I was at Costco recently, supporting the incredible business that is Costco.
Of course.
And they had a whole display for Quest 2, which I believe is
really
Oculus, right, from Facebook.
Yeah.
So that was cool to see Costco Facebook partnering with Costco to move some product at $400 a pop.
I wonder how that's doing.
Yeah.
Your bargain discount on virtual reality headsets.
Yeah, well, what's the retail? What's the normal price for those? Do you guys know?
It can't be much different.
Yeah.
I'm not too sure, though. Quest 2.
What's the newest Quest? Is it Quest 2?
Looks like it.
Oculus themselves sells the Quest 2 for $400. So that sounds
there you go.
About the same. So wholesale prices, I suppose, same as Oculus. Walmart sells them for $400. So
there you have it. But yeah, what have you guys seen on Facebook? I don't even know what the price is. Last I saw it was around 200.
It's below 190 now. I think it's mid 180s. I think as of end of today.
Okay.
I haven't checked since the morning. Frank, I know you did a recent sort of updated valuation video, just kind of going through some potential scenarios. Focused a lot on their buybacks that they would theoretically be doing. Has your conviction changed at all as it continues to fall in price?
Well, I'm currently doing a write-up for my newsletter as well, so I am diving pretty deep into Facebook at the moment.
Subscribe.
Only in the early stages for that still, but it's just the ads business is great. I think definitely that's been undervalued by the market at the moment. Like, it's not going to disappear. There's obviously increased competition for the amount of time spent on these apps, and even within the Facebook community or the family of apps for Meta, people are spending more time on something like Reels, where it's harder to advertise. So definitely it's going to be a difficult time period for over the next 5 to 10 years, and probably forever now for Facebook. But I don't think it's going to disappear. I think it's still going to be a very cash generative business, arguably one of the most cash generative businesses ever to exist. It's crazy. Like 35% operating margins or something, growing at 40% roughly over the last 10 years. It's an insane business model. But the main question is around the virtual reality, augmented reality space, which is probably unknowable. I don't know where I'll end up on that by the time I kind of finish my research in the month. I don't think I'll buy Facebook because it is somewhat unknowable. But overall, like more broadly on augmented reality and virtual reality, I think it is likely that this is the next mobile phone or computer. I think it's going to be a very regular part of our lives in the future. But whether or not it's Facebook that wins that space, I don't know how to understand that well enough. I guess if you're looking just before the iPhone come out, no one would have predicted that an iPhone would be as successful as it is. And then I guess before computers, or more specifically laptops, were so much a part of the day-to-day life for everyone on the planet, really, I guess in first world countries, no one would really know that's coming. And I guess no one really knows what's next, but the general direction, I think, has to be towards virtual or augmented reality, or a combination of the two. I think Facebook or Meta are spending the most capital in that space. They're going to have competitors with, I guess, Google, Microsoft, maybe Apple, things like that as well. But yeah, to know who wins and how profitable and the margins and everything is so unknowable, and it's such a big change in business model. I guess it's more of a hardware logistics business then, if they start to win this with, say, Oculus, with the Quest or whatever it is. So very hard to predict what that looks like. And there's a lot of CapEx and a lot of research and development going towards it. So it does hurt that ads business. But I don't think the ads business is going to disappear. So if you buy Facebook, I think you have to write off to almost a zero the kind of Reality Labs business as being unknowable, unless you're an expert in that, I guess. And then you're then valuing the actual ads business and seeing whether that's worth more than the current market price.
Yeah, I would tend to agree. I think Jason in a previous episode, our after dinner investor friend, mentioned that this is almost like a VC play, like venture capital. It's much more speculative. You don't really know what's going to happen, but if it does pay off, it'll pay off pretty handsomely. And so you can't really assume that that's going to happen because there is a ton of risk. So I would definitely agree with you, Frank, that it's really more about focusing on that ads business that's really throwing off all the cash right now. And if they burn a bunch of cash towards this this experiment, then so be it. So you want to get it at a price where that would make sense if you're trying to build in the sort of margin of safety there. I think a bigger question a lot of people might have is, what about shrinkage? They haven't shrunk their cash flow anytime recently, but if their user base shrinks at all, or somehow they can't grow revenues anymore, or something happens like that where the growth just flat out stops. Not saying that's likely, but could happen, since they're already at like 3 billion or whatever users. They can only get so many on the planet. How many more avenues are there outside of just the ads business to actually grow that? So
I guess within that, it's the increase in kind of dollars per user in the rest of the world type markets. Like, I know the Asian Pacific region is very undermonetized compared to something like North America. So there is room for growth in cash flows, I guess, but the top line figure of daily active users or monthly active users, I don't see how it can get any higher. It's something like 30% of the world's population as it is. And then if you put that into, I guess, between 16 to 50-year-olds, I guess, would be kind of the main users, then it's probably like 60% of the population, or over half anyway. So there's not much room for growth on that top figure, but it's whether or not they can continue to increase those cash flows. But more importantly, even if they can keep it flat, would be a win for Facebook, I think. If they can keep generating roughly $37 billion in free cash flow, then they'll do absolutely fine. They could just pay that out to shareholders and it would be a great investment. So I don't know. It's a hard one to wrap my head around.
You want to get it at the price where it's a heads I win, tails I don't lose much, in that if they can just be stagnant, if the metaverse stuff is a complete wash, you're still coming out with a decent return long term. I think that's the real goal here.
For anyone interested in Facebook, I enjoyed the conversation between Monish Pabrai and the SumZero CEO, Divya Narendra.
Divya's the one where you said it was a double.
Yeah, so Pabrai thinks, Facebook is an easy double with just the ads business kind of maintaining, maybe growing 10% over the next 3 years. So Pabrai's thought was, well, I could see a case where you buy Facebook today and you wait until it doubles, and then you reassess the Reality Labs piece of the business when you have a little bit more. You can see what they've done over the last 2 or 3 years while you've gotten that double to figure out if you want to carry on with Reality Labs going forward. So, that makes a lot of sense to me. So I don't necessarily think there's much risk at present prices, even if the Reality Labs thing falls on its face.
Sure.
But that's just Pabrai's take.
All we need to happen is another Alibaba episode, or just keeps falling for a few months.
Yeah. and then harder to see that happening here. But
yeah, I would agree. It's just given the country it happens to be based in. That seems to be the big difference.
But I mean, if the Fed tries to raise rates, I mean,
Oh
we
yeah,
could really still be in the very early innings of blood in the streets. So
I'd agree. I would definitely agree there.
it's all speculation. But
I can't say I'd be surprised if it halved from here, just based on sentiment
yeah,
alone.
yeah.
Even if nothing fundamentally changes, I would not. And really, you can't. I guess you can't really be surprised if it happens to any stock, just because the short term can be just so wild, just based on sentiment and
Yep.
macro factors and things that you never predict, and then they maybe right themselves a few months later. Just it can be crazy how fast things happen.
And of course, I'm remembering back to the kind of the bottom of the pandemic, right?
Hmm.
March 2020, where
The
it
2 week
felt like
the 2 week
it felt like
crash.
it was going to half and half again, right? It was going to keep going down, and then boom, it popped, and so many people kind of missed great buying opportunities there. So it's tough, It's really kind of battling the psychology.
The circuit breakers going off almost daily for a while. That was pretty
Right?
nuts. Multiple
Yeah,
times a day.
that's right. That's right. So who knows?
Yeah.
What else do we want to talk about?
Well, Jack, I just shared that spreadsheet with you if you want to pull that up quickly, just to a rough
sure.
valuation for Facebook of kind of how things
There's our
could play
boy.
out.
There's our boy Mark.
We got Mark flashed his face for a moment. All
Okay,
right.
what are we looking at here?
Go ahead, Frank.
Facebook DCF.
Yeah. So just looking at, well, one thing I missed in the video is that I didn't factor in how much the increase in CapEx would be affecting free cash flow next year. Whether or not that contributes to kind of owner's earnings, like how much of that is maintenance versus growth CapEx is hard to know. But on a strictly free cash flow basis, some of the assumptions I have here. So if they decline 15% in free cash flow, which I think they're going to spend, off the top of my head, around $20 billion in CapEx next year. So if you assume a little bit of growth in operating cash flow and then huge increase in CapEx, maybe around a 15% decrease, then relative to that number, if they don't continue to increase CapEx by a significant amount, at least anyway, the 15, 10, 8, 5% growth over the next 4 years following that is still well and truly below the 40% average, I guess, over the past 10 years. Not to use historical numbers too much, but relatively this is very low for Facebook. And then I'm assuming $30 billion buybacks every single year. That's a stretch. Like there's no guarantee that happens. They bought $50 billion worth of shares back last year, and they still have an approval to spend, I think, 33 maybe off the top of my head. So it's likely they use that while they've just got significantly cheaper. They paid $50 billion for almost double the share price, so I don't see why they wouldn't do that at this price. I would be concerned if they didn't, probably. And then they probably continue buybacks into the future, maybe. I would like to see that as a capital allocation decision. And then the other assumptions, I guess, are the multiples, which they're currently 13 times price of free cash flow. I can't see it getting much lower unless things get dramatically worse for the company. So
Yeah.
I've assumed a little bit of expansion. I actually put it down for this year since free cash flow is going to drop off. Maybe the multiple drops off a little bit more than it already has, even though that's probably priced in. But that gets you to about a 14% return, which is a reasonable return in that scenario. That's one of many scenarios that could play out, obviously, but I don't think it's the worst bet to make. If I had a more diversified portfolio and I was kind of looking for more market average type returns, I think I would own Facebook at current prices. But I'm kind of looking for a much higher hurdle rate at the moment and a more concentrated bet. I just can't kind of get there on Facebook at the moment, but
I
think it's reasonable.
Are you increasing your? I know you typically have used something like a 15% hurdle rate. Have you moved that up at all, given just the current volatility and maybe the different opportunities out there?
Yeah, I've bumped it up to the classic 26%, the double in 3 years. Most require classic. Yep, 26%. And I guess that's just an additional margin of safety as well. But
sure,
just after a conversation with a few people, Tristan Wayne being one of them, who was the idea of killing one, because it is just a margin of safety, but also having that lower hurdle is kind of leading towards market average returns.
Yeah,
I'm taking on more risk. So when I take on more risk, these hurdle rates are usually higher for some of the more illiquid companies. The returns can typically be higher. Not to say that it plays out the way that I think it will, but yeah, if I kept with the 15% I used to kind of have in my mind, I could be making a lot of investments right now, and I don't want to be making a lot of investments. Obviously, some hurdle rates, a 15% hurdle rate for two different companies is different. Like one could have less risk, so maybe the other one's better to make. But for now, I'm running with a higher hurdle rate. I'll see how I change my mind in the future, but I like the 26%.
That makes sense to kind of calibrate your hurdle rate to the environment, right? Because it's all about opportunity cost, and
Yeah,
you want to buy the best thing you can in any given moment.
and you could argue that maybe before inflation was nearing double digits in the US, at least, maybe you would consider you could almost look at it like, okay, you have 15 is kind of your base case with little inflation. Add 7% nominal inflation. Now you're up over 20%. So you could do you look at inflation at all when you're tuning your hurdle rate?
Not so much, and I guess it's not so much a reaction to the environment, but more so to my strategy overall. I think I'll try to keep it at that way, regardless of what the market is doing. Yeah, I don't know.
Yeah,
I don't think about inflation too much. That's another one of those unknowable things in my mind that I'm just like, what do you do?
I've been considering actually bumping mine up. I've been kind of rolling on the 15%. When I'm looking at real estate deals, I try to get 10% cash on cash return, and that's extremely difficult to come by right now. A lot of kind of like 5 to 6% cash on cash deals that I've seen in some markets, which is like, it's decent. But at that point, it's like, might as well just buy an okay stock that could get me 10, 12% over the long term. Granted, it's a different game. You got debt involved that can bump that up. But I'm considering raising my my own discount rate for stocks as well, probably closer to that 20% mark for that same reason of margin of safety. And then when you're picking stocks in a more concentrated portfolio, you really need to have some sort of margin somewhere, because there's a high chance you're going to be wrong on something. And that could really hurt your portfolio in a bigger way. And if you can build in a bigger cushion, of course, that's rarely going to hurt. So Jesse says no to cash on cash return. It ignores the time value of money. Well, sure, but you got to start somewhere for year one. So, and I would be reinvesting that cash, but just kind of a measuring stick. I know IRR is the preferred among most kind of real estate deals if you're holding for, say, 5 to 10 years. And yeah, there goes Jesse, IRR. So, yeah, so I'm considering raising mine as well. It's a wild environment.
Indeed.
Taking a look at some of these questions here. We get a few more in before we wrap up.
Yeah, if anyone has any burning questions, hit up that super chat.
We got a before we see any super chats roll through. We got some Jonathan here telling us that
what's Jonathan telling us?
Jonathan saying, when will we admit everyone on this stream is better off passively buying the index? I saw him later in the chat bring up the fact that respectfully, Jonathan says he's a fan of our content, so we appreciate that.
But we didn't show that one. We're just showing this one. But
we're showing this one because it's a good question, albeit terse. He says that he says that Warren Buffett recommends this to 99% of people. 99% of people that you should just buy an index. Don't do what I do. Don't do what the big investors do in picking stocks. And many big investors actually ride a lot of indices as well. So it sounds as though they don't do that. But he says the average person should just buy an index. I guess really the ultimate question is here: are we the average investor or are we not? Which is kind of this whole game.
Have you guys ever met an average investor? I'm not sure that I have.
No, everyone's above average. Every single person.
But it is a good question. It's a fair question.
I talked about it recently in one of my videos about my investing strategy, and I genuinely agree with what he's saying. I think everyone in this chat, probably all of us talking, should probably be invested in the index.
Chances are.
Yeah, it's unknowable to know whether in the future we're right or wrong doing what we're doing. I'm willing to take that risk while I'm younger. That's kind of what I've always said. The older I get, the more money I have in my portfolio, the safer I'll play in my investments. I'll diversify. I'll become more defensive. I won't invest the way I do right now forever. It's just at the point I can save a significant amount of my portfolio each year, maybe around 30% or so each year relative to my portfolio value. So I can afford to lose a lot of money at the moment. When I'm 40, that's different. When I'm 50, that's very different again. So it's hard to say I'm going to outperform the market. I have a feeling that I might be able to just outperform, taking the few advantages that retail investors can. But I don't know whether that plays out. And I think definitely I agree with most people should just buy an index and be done with it.
My thought to this, like it definitely takes some arrogance to go for it. And it's frustrating because you'll never know if you're actually right until 20 years from now or more. And that's the frustrating part. It's very hard to, you can look at past data but past data doesn't indicate future performance. So that it's difficult. But I always think, why not just do both, especially if you're worried about this sort of thing? I think you should be worried about it in some capacity. Have kind of like an insurance portfolio. And if you can't afford to build up an insurance portfolio, find a way to do it, boost your income, focus on that first, perhaps. And if you want to stock pick, but you're worried about this, consider just putting a portion towards indices and ride that. Like that's what my retirement accounts are. If I fail at everything in real estate and stocks for my own picks, I should have something, broad index funds, to fall back on. It won't be as lavish as if everything went well, but at least there's something there. So that's kind of my thinking on it. It's how I sleep at night, I guess. And also similar to you, Frank, being I definitely look at future earnings. While we're young, it's a big advantage in that you can take bigger swings and misses because you have time to make it up. You have earnings that you can bring in to replenish that portfolio that way.
Yeah, I mean, I will point to the article on, I mean, obviously in hindsight, this is clear, but the article that I think it's called Imitation is the Sincerest Form of Flattery, where, you know, if you had cloned Buffett's public equity investments over 30 years, you'd double the returns of the market. So, you know, I still think there's opportunity to identify, certainly to do your own work if, you know, you have a lot of time and energy to devote to that, but also to really just identify who are the outstanding investors of our time and see what they're buying. You know, it's all out there in 13F filings, assuming they have a big enough fund, and try to reverse engineer. You know, it's a game that we get to play if we want to, and try to reverse engineer why they bought these things and try it. And like Frank said, if you're young enough, there's not huge stakes in terms of trying when you're young and then realizing, okay, I probably don't have what it takes to do this, and just being an index investor from then on out. But
it was never about the gains. It was about the friends we made along the way.
Is that what this is about? Is that why we're doing this, Jack?
Yeah.
Good.
I actually hesitate in the sense that when I play more defensively, whether I actually buy ETFs or indexes specifically, because I enjoy the research, I enjoy everything about investing. I like following these investors. I like meeting people. I like researching companies. So I'll probably just buy 20 to 30 stocks, which essentially is an index. 30%, right. 30 stocks is the same as owning an index statistically. So as long as you don't kind of cram into one industry, I guess, would affect that. But that's probably what I'll do to be more defensive, and that's probably what most people should do. That would still leave you with a chance of outperforming the market, assuming you can find 30 really good companies. I don't know that I could, but yeah, that's probably what I'd do to be more defensive. But the average investor, well, firstly, the average investor isn't what we're doing, I guess. The
No.
average investor is more diversified and they do own kind of more growthier names, particularly over the past 10 years or so. They're not concentrated investors focusing on smaller liquid companies internationally. So that's the advantages that I kind of like to focus on with the hopes of outperforming. But yeah, I do think most people listening to me probably should be, including myself, should be invested in indexes or more diversified.
You guys heard it here first. And just to be clear, I think it's a little misleading when you say passively investing in an index, because there are decisions to make. Most investors who think they're being passive underperform the market because they pile in when everybody's excited about the stock market and they pull out when everybody's running away. So there's still, you still got to master yourself to some extent in terms
That's
of
well said.
not making emotional decisions. So it's not completely passive, but there's less to grapple with for sure going that route.
Right. That's right on. That's it.
I actually have. Oh, sorry, go ahead.
No, go Frank.
I just have a guy that I work with, and he's invested in a couple of different ETFs, an Australian one, an S&P 500 one. But he always talks to me about how he's real concerned right now and he wants to sell. And I have to reassure him almost every day. I feel like it's just hold him. He's only been doing it for about 2 years, and I'm like, that's not the game you're playing right now.
Just
particularly for index. These indexes need to be even more like do nothing. Like that's it. This is a 30, 40 year.
That's the whole point.
It's even like, I guess, Brad, all of us, we try to be a little bit like do nothing, but in investing in indexes is more so like don't look at it. Just put a certain amount every single week, month, whatever it is, and look at it in 30, 40 years.
And try to grow with the world.
And there may be some benefit to putting 90% of it in an index and then tinkering with 10. So you can actually do something, right? You can do something with the 10% and let the 90
to activate the lizard brain.
That's it.
Must do activity to just get it engaged in something.
Yep.
There is something to be said there.
Tunism just said, if you can pick 30 above average picks, doesn't that mean you beat the market? Yeah, exactly. That's what I would try to do if I was being defensive. That's the
you might not get all 30, right? Right.
No,
you might not get all
exactly.
30.
But if you enjoy what you do and you want to be safe and conservative, you don't want to lose money, then it's to try and find 25 to 30 above average stocks. If you want to outperform, you should probably look for 5 to 10. And that's the lower you go in concentration, the more likely you are to outperform or underperform. So it goes both ways. If owning 5 to 10 stocks is either a great thing or a terrible thing. There's no market average return with that.
Well, chances are low, at least.
Chances are low, yeah.
The range
obviously,
is
there is a chance to be exactly the same, obviously.
That would be frustrating. You go through the return on brain damage of having 5 holdings, and you end up getting the same as just buying an index and calling it a day.
Not the worst.
I just realized we got a super chat from Jason. It didn't pop up for me, I think, because I'm scrolled up in the chat.
I purposely ignored it.
Well, he got us at that $1.99 discount. Amazing deal. Thank you. Will you buy Navios, the one he pitched at the end of our last episode, or Huapeng?
Or Coupang.
Is it Coupang?
That's how I was told it was pronounced.
I've never pronounced it that way, so
there you go.
I'll take your word for it.
Coupang, the Amazon of Korea.
It's probably Coupon, but who knows? Our anglicized pronunciation of it.
One of my Twitter followers spelled it out for me, so it helped.
All right, I'll take your word for it then.
I'm in for neither. How about you guys?
Well, Coupang, no, I looked at that very quickly a long time ago. I'm just pulling up. What
put you off on Coupang? Just out of curiosity, Frank.
I don't even remember. There was a huge buy by someone in 13F. Is that right? Or like
Druckenmiller bought it. I think somebody else bought it.
But it's essentially just a crappy Amazon. I might eat those words so hard one day because I don't understand the company. I don't understand it.
It's going to
at
go to
all.
the moon, and Frank's gonna be
Buys
like,
Amazon, literally buys Amazon.
I don't remember why, but it was a 3-minute quick pass for me. It was.
Yeah.
I didn't look into it. I looked through some of the numbers on ticker, and that was it. So maybe I'm missing something huge, and I probably am. But yeah, that's not one that sparked my interest. And I just pulled up Navius Maritime Partners. That seems more interesting, I guess. It's trading at like 2 times earnings or something. I guess that is why Jason was interested. I know he pitches the 1 times PE. He really likes that idea. And they just had some huge amount of growth. So there's a lot of things I don't know. And this is kind of me admitting that I didn't watch your episode last week.
Yeah, the general pitch is that depending on how you value the ships, which are dependent on the actual price of containers, and like container shipping prices are through the roof right now. Because of that, the ship values are also really high, and you can make an argument that they're trading for well below the actual liquidation value, I guess you could say, of their fleet. So the question
is, such a boom and bust industry, though.
Yeah, I mean, right.
Those ships are going to be scrapped in 2 or 3 years.
Why did revenues triple last year? From being flat from ages.
I believe it's just because shipping prices have skyrocketed. And I want to say they had like a couple ships offline or something for a moment. I don't remember exactly, so don't quote me. I'm going completely off of what Jason told me and told us on the last stream. But it was a good pitch. I just haven't had time to take a look at really anything over this last week in any real detail. But I have thought of it a couple times, like, I wonder if that's worth taking a look at. Sort of related to kind of like the commodity spike. Maybe there's a way to ride this for a while. But I think Jason was saying that they're planning on not doing high dividends. They're going to kind of hoard the dividends. And I think that's kind of a big appeal when you're riding like a commodity cycle, or in this case, like a shipping cycle, if that's a thing. In that you want to get your capital out quickly, so that you get your returns that way. But I mean, there's you can make an argument to not do that. But again, I'm really speaking as a layman here. I'm just going again off what Jason was really saying.
I think
Jonathan gave us a super chat, guys, just for spending the time.
Well, thank you, Jason. And anything else here?
No, I guess from a very quick glance, and this is me not hearing the pitch or anything, the appeal would be a special dividend after a huge boost in sales and free cash flow that otherwise they were an unprofitable company. They were at the bottom of the cycle, I guess. How long can they maintain current prices? Maybe a while, I don't know, but I would want to see that get forked out to shareholders pretty quick, and then it would be appealing. It'd be some huge yield. I don't know. I have to run the numbers, but anything that cheap could go extremely well, or it could do absolutely nothing. So I don't know.
Oh, that was the same Jonathan who asked us a question about Jonathan. The index. So thank you, Jonathan. Glad we gave you a satisfactory answer, and we appreciate your support.
And cloning the 199, that's clever.
A bold move. Cloning Jason's index of super chats.
All right. Any last burning?
Oh, hey, the man! Another one.
He's doubling down like Charlie Munger right now.
Tripling down. Yeah.
Thank you, Jonathan.
Thank you, Jonathan.
Can we end with the Zuck?
I imagine we will.
We'll have to. I got to find the actual picture in my. I guess we can end with that. Maybe one more question, and then we can call it a day.
If Jonathan has a question, we could prioritize that.
Jonathan, you've earned another question if you'd like to. Take a look real quick here.
SC said something like, I'm 10 minutes behind. I'm kicking the index's ass over a 3-year rolling return, Jonathan. No thanks. I'm gonna swing.
There we go. We gotta get SC on eToro so we can clone him.
So I feel like I have the same kind of bias there, I guess. Like I've had great 3-year returns as well. I talked to SC outside of this, and he's even better than mine too. So it's easy to have that bias where I think I can do this forever, but realistically, I probably can't. But hopefully you're right, SC, and hopefully I am too, and maybe one day we'll be very rich.
And I think SC has one word for everyone. Like, what was it where the one word was plastics? It was some movie. I have one word for you, plastics. For SC, I believe it's lumber.
Yes.
So,
he fills the Discord with plenty of lumber content, and it's great.
He's got a Woody for wood.
That's one way to put it. I think that's a great way to end it, actually.
Right? Well, we know how we're going to end. That wasn't it. We still have we got a shot here to show.
Yes. So with that said, everyone, we appreciate all the people who stopped by today. We had a pretty dense audience today, and in a good way. I mean, dense numbers wise. So we're loose here in the chat. We're not dense here. So thanks for stopping by. Be sure to smash that like button. Subscribe if you haven't already, so don't miss future live streams. We try to go live around this time every week, though, with daylight savings coming up in the U.S. I don't know if that's going to throw things off for people not in the U.S. Well, stay tuned for that. It'll be around this time, plus or minus an hour, starting next week. Check out all the links in the description, including the Discord, share site, and we also kind of mention the merch shop every now and again, where we can get some punch card and shameless cloning merch that Karan has put together. So check that out too.
Supports the Dakshana Foundation.
Yes, it does. But with that said, let's sign off here with, once again, our very own, who really wants you to invest in his company that continues to fall more and more each day. Is it a value? Wow. Is it a value opportunity? Is it a value trap? The world may never know, but you're investing in this guy. And if you want to do that, then it's a great opportunity. All right.
This is not financial advice.
Not at all. Goodbye, everyone.